Africa Real Estate Development Summit. This is the first time I'll be attending this, and I believe this is the first edition in West Africa. I'm incredibly excited, and I hope that this will be a productive and rewarding couple of days for everyone participating in this summit. My name is Lanre Fatimilehin. I work for Jones Lang LaSalle, which is a real estate services firm. I'm based in Lagos, and I deal with capital markets. And I'm going to spend the next few minutes providing some background as to where we are in the real estate space in the region and what it means in West Africa. And my aim is just to set some context for the discussions over the next couple of days, not just in the panels that will follow, but amongst everyone here. So let's start with the macroeconomic backdrop. Between 2012 and 2015, many West African countries experienced high growth. But we all know what happened in 2016. Growth slowed considerably, with the average coming down to 0.5%. And this was driven by a slump in global commodity prices. Nigeria, which contributes about 70% to regional GDP, dragged down this regional average. Growth has since rebounded in 2017 to 2.5%, and it's projected to rise to 3.8% this year and 3.9% next year. But we need to deconstruct this average number to understand how individual countries have performed. For instance, Côte d'Ivoire and Senegal have emerged as two of the continent's strongest performers, and they've been aided by political stability, economic reforms, and infrastructure investment. Ghana has also shown strong performance. Conversely, in Nigeria, which remains heavily resource dependent, growth has remained slow due to the slower than anticipated recovery in the oil sector. But it's not all bad news. Rising commodity prices due to improved global economic prospects should boost growth in the short to medium term. But for this to happen, oil production needs to be stable, and we need to have reasonable oil prices. In addition, we've seen an increase in external debt and borrowing. And what has driven this is the slowdown in economies when commodity prices slumped. So we've seen debt to GDP ratios rising. They're projected to hit 40% in 2018. And this borrowing was used for expansionary fiscal policies when oil prices fell. Now, moving on to currency. I mean, currency is quite complicated, but we've seen high exchange rate volatility in Ghana and in Nigeria, who both experienced significant currency depreciation between 2014 and 2016, although they are now back to a period of stability as oil prices have started to improve and monetary policies have become investor-friendly. And in Francophone countries, of course, we've seen very stable exchange rates. So what does all of that mean for the investment climate? The region is ripe with opportunity. And of course, everyone talks about the huge investment potential. But West Africa is still a very, very challenging place for investors that are looking to deploy capital. And these challenges are numerous. They include an unavailability of finance, inadequate infrastructure in terms of energy and transportation, weak tax administration that is heavily focused on the formal sector and ignoring a very large and growing informal sector, rigid regulation and inefficient bureaucracy. So when you look at how countries are doing in terms of doing business, In West Africa, Ghana ranks highest at 120, followed by Côte d'Ivoire and Senegal at 139 and 140 respectively. And Nigeria is in 145th place. But to put this in context, Mauritius is ranked 25th, Rwanda is ranked 41st, Kenya is in 80th place, and South Africa is 82nd. So there's a very big gap between our region and some of the leading economies on the continent. Also, West Africa's integration into the global economy is low. And according to the World Bank, West Africa only captures about 5% of Africa's total FDI. I mean, there are many reasons this is the case. You know, some people say you have cross-border constraints and a lack of regional integration. So there's an inability to scale investment across the region. And in addition, people also cite regulatory instability, especially with regards to monetary policy and capital controls. So in Nigeria in 2016, there was some currency rationing and limitations on capital repatriation. So all these really clouded the investment environment. And from a capital markets perspective, West Africa still has very shallow capital markets, low levels of domestic financing, and international debt funding remains mostly reliant on DFIs. I've mentioned currency volatility before, and it remains a serious problem. And you have a situation where international investors' preference obviously is to lend in foreign currency, but businesses want to manage the exchange rate risk by borrowing or getting investment in local currency. Also, for equity investors, many find it very difficult to obtain an exit for their investments, and secondary markets to buy out investments remain hard to find. Clouding everything on top of all this is the global economic environment with a retrenchment from emerging markets as the US Federal Reserve has begun its tightening cycle and they've been raising interest rates. So where investors in the West were forced to take more risk and invest in emerging markets to get a return, now that interest rates are going up in the US, they're rebalancing their portfolios, revolving out of emerging markets into more mature markets. And on top of all this, we still have the trade tensions that have resulted from the United States and China. So to summarize, Nigeria remains a sleeping giant for investors, very difficult to understand and work in, but with the potential for great financial returns if well understood and mastered. Ghana has been improving its business environment and it's attracting increased interest. And Senegal and Côte d'Ivoire are attracting a great deal of interest, as I mentioned before, due to improved fundamentals and strong growth. So what's going on in real estate then? Gross fixed capital formation is a measure of the net increase in physical assets, including infrastructure and real estate in an economy, but it's varied a lot across Africa. In sub-Saharan Africa in 2016, according to the World Bank, gross fixed capital formation as a percentage of GDP was about 20.1%. Nigeria is below this average, and Ghana is just above this average, but this has trended downwards from 2012 when it was just above 30%. And as a rule of thumb, the rule of thumb is that economies need to invest about 30% of their GDP in gross fixed capital formation in order to create an environment conducive to growth. So for West Africa, according to Deloitte's construction trends, which takes a selection of projects valued above $50 million. West Africa had about 79 projects with a total committed value of about $98.3 billion. Nigeria had the largest number of projects with 30 and a dollar value of 70% of the regional total, followed by Ghana with 14 projects, about 18% of the regional value, and Senegal with 13 projects and 16.5% of regional value. Deconstructing this a bit more, majority of these projects are owned by governments, so they're promoted by governments, about 80%. And private domestic firms own only 3.8%. And governments are funding the majority of these projects. So in terms of dollar value, governments are funding about 33% of these projects, followed by Chinese firms at 16.5%, African DFIs at 12.7%, and international DFIs at 8.9%. And I think when you look at these figures, we need to be asking ourselves how we can really mobilize private sector involvement or investment in real estate and in infrastructure. Because clearly, government funding is not sustainable. And with the expected overhang from increasing debt levels and commodity volatility, we need to bring government funding as a share of these projects down. I mentioned Chinese contractors, and these guys, they are the dominant builders for projects in West Africa, but not necessarily for real estate. I'll come to that later, with about 23% share, followed by private domestic firms with 21.5%. And we're getting contractors for these projects also from France, which has 10%, Italy with 7.6%, and Brazilian and US firms with about 5% each. So Chinese investment has been focused mostly on infrastructure and not on pure play real estate projects. But investment platforms such as the partnership between the IFC and CITIC Construction is looking to deliver large-scale housing developments in Kenya, Rwanda, and Nigeria. And the value of that is about $300 million. So we're hoping to see more of that going forward. But what is driving real estate investment? We all know of the Africa Rising narrative, which took hold some time ago during a period of high commodity prices and a lot of focus on emerging markets. Low interest rates in the West driving investment inwards to this region and to sub-Saharan Africa. So the story was that, sub-Saharan Africa is rapidly urbanizing, and Africa is the least urbanized continent in the world, with only about 11.3% of the world's urban population, according to the United Nations. And by 2050, Africa's urban population is projected to reach 1.2 billion, with an urbanization rate of about 58%. So this will mean 1.2 billion urban residents by 2050, and an estimate of about 4.5 million new residents in informal settlements or slums every year. Demographic trends are also favorable for long-term investment, and the working age population for Africa is expected to be about 1.1 billion in the next 30 years. So that's going to be greater than India and China. So what are the key takeaways here? Firstly, a significant portion of this population is going to be located in urban cities, which are drivers of economic growth. Secondly, the sheer volume of informal settlements that will grow and existing cities cannot accommodate the resulting urban sprawl in terms of infrastructure and housing. There's also a need for housing at various levels of affordability because of the huge housing deficit. So as of 2017, The estimated housing deficit in Nigeria was about 17 million units. In Ghana, it was put at 1.7 million units. And in Senegal, the annual estimated deficit is about 250,000 units. There are a lot of supply-side issues relating to housing: land tenure, title, poor infrastructure, an informal and poorly trained construction labor force. And on the demand side, just a lack of mortgage credit and savings. But in response to all these challenges, we are seeing the creation of new cities, fashioned as mixed-use developments. And we're going to hear later from two developers of the schemes. And these cities offer good planning and infrastructure, and they are typically satellites to existing major cities where many people still make a living. Examples are Petronia City, Apollonia City, King City, Diamniadio Lake City in Senegal, and Eco Atlantic. And there's, across sub-Saharan Africa, the estimate is about 1 billion square meters of new city projects with a value of about $115 billion. In addition to this, governments are trying to achieve macroeconomic stability by diversifying their economies. And governments are looking at opportunities in agriculture, technology, retail, and manufacturing. And these have created further opportunities that investors have sought to exploit. So we can see the case with retail, for instance, where institutional investment from the likes of Actis, RMB Westport, Novare, Resilient, HC Capital has taken the lead in developing modern retail space in Ghana, in Nigeria, Cote d'Ivoire, and Senegal. But with the disruption caused by the commodity volatility, developers are having to review their models away from these large regional malls to smaller, well-located centers. We're also seeing developers starting to develop modern logistics space with the aim of improving distribution and supply chains. And this has also been partly driven by the e-commerce boom. So we have developers like Agility building logistics parks in Ghana and in Nigeria. And developers like Rendeva incorporating industrial components as part of their master plans. So to round up, there's a large opportunity, but there's plenty of room to make mistakes. And a deep knowledge of the market and the actual need is very important. In addition, in terms of funding, financing needs to be patient and long-term and tailored to take account of the region's unique real risk profile. And I think in the end, once we can all master this, everyone across the real estate value chain will benefit. So the key questions I think we should all be thinking about over the next couple of days are, firstly, how we can encourage private capital, both domestic and international, to flow into real estate development projects across sectors, including housing and commercial. Also, are public-private partnership schemes working? And can we make them work for real estate? And I think, importantly for this summit, how do we balance local content with the need for imported building material inputs for projects in order to manage foreign exchange risk? Also, what type of financing makes sense for development in this region? And given the long-term investment horizon, what needs to be taken into account? So I think we're going to get answers with the panels and in all the discussions we'll have today. But thank you for taking the time to listen to me this morning. I know it was a lot to absorb, and I hope the coffee is kicking in. And our next item on the agenda is a keynote speech from His Excellency Birender Singh Yadav, the High Commissioner of India to Ghana.